Today, I'm going to show you how you can make £10 a week in dividend income completely passive. So you can sit there on your mobile phone knowing that you're earning £10 a week for free. What's that, like 2 or 3 meal deals at Tesco's? Can't complain with that. So let's show you exactly how to do it. Now, before when I'd done this, I'd given you a few stocks that you could buy and hold for the longer term that do pay an attractive dividend. Those companies still pay those dividends and they're still attractive. However, I want to be able to show you what you can look for in a quality dividend investment so that therefore effectively you can therefore pick your own dividend stocks and really know what to look for, have a greater understanding of what's going on. So dividend income is the easiest stream of income, and you should probably know why, right? Because it doesn't require much time or energy upfront to generate this money over the longer term. The only thing it requires upfront is money itself. Now this sucks for an individual that doesn't have much money to invest or spare, but fear not, over time this is a great strategy for building up an additional income stream as you save aside money. Now dividends are attractive because they can grow over time. It's different from sitting in a bank account where you've got a fixed interest rate that might not give you that much of a return, maybe 3.5% at the moment, but quite frankly, that's not enough. Instead, you want to buy a company that's growing. And don't forget, dividend income isn't only dividends. You've also got the capital gains approach, which I'll get more into later in the video. So we could first look at fund suggestions for income. Like, what could you look for? Well, we could talk about the FTSE 100, right? The current FTSE 100 yield is about 3.72%. Now that's pretty high, and this is one of the highest yielding funds. The FTSE 100 is 100 largest companies on the London Stock Exchange by size. Let's just say size or market capitalization, which is their value on the stock market. Now, if you invested money and you wanted £10 a week in dividends from the FTSE 100 in one of these index funds, you're pretty much looking like you're going to have to invest about £13,978. Now that would give you an annual income of about £520 a year, but the thing is with these funds is that typically, unless you can find one, they might pay you monthly. At most, you're not going to get this on a weekly benefit. So again, that's a disadvantage there. But overall, if you see the same picture, you might get paid once a year £520. That is still £10 a week. So you could take that income and budget it over that period and do well. However, I personally prefer the idea of reinvesting these dividends. So £10 a week today could be in 5 years time £20, £30 a week, and that could be a lot more for your strategy. Now you could also look at the other UK market or the other UK major index, the FTSE 250. Now this is the 101st to 351st biggest companies in the UK. Right, now this has got a yield of 3.25%. This is known that it's got a bit more growth, but again, you might want to invest somewhere else. At a 3.25% dividend yield, it's very simple maths here, you would require £16,000 invested in order to generate that return on capital. Now let's say, okay, look, actually, I prefer America. What about the S&P 500? Well, the S&P 500 is yielding about 1.7% at the moment. This means if you would want £520 a year or £10 a week in dividend income, you would need £30,588. So effectively let's just say £31,000. That's quite a lot of money for this level of dividend income, but again, you're probably going to get more capital appreciation from it. Typically, the higher a dividend yield is, the riskier it could be seen. Now, there's always opportunities, and it always could be, underpriced, where an investor doesn't realize truly the quality of the company. But a red flag in dividend investments is the higher the yield. If the yield is so high, why aren't investors buying the stock and that yield is dropping down? And that's where we come into, for instance, the FTSE 100. So if I jump back into, let's say, Dividend Data, by the way, I prefer this to DividendMax, but you can also use that software as well. In Dividend Data, I can go by annual yield and I can scroll down. Now, you've got a few of them that are anonymous or ridiculously high. You've got Foreman right here, which is a house builder. I feel that dividend cuts are quite likely in this sector given the ongoing property market, and obviously with interest rates rising, the demand should effectively slow down. So a 19.31% yield is probably priced in by investors at the moment that that's going to be cut in the future. However, we scroll down a bit more. Now we look at these companies that have more slower growth. They're not really going to be growing anytime soon, but they throw off loads of cash, and I'm talking the likes of British American Tobacco, Legal in General, for instance. Let's say even some of the retailers like Kingfisher, very, very diverse and big companies that likely aren't growing too fast, but they do throw off a lot of money. Now, if we want to look at one of these, let's say I'm going to go for a lower yielding one here, just for example, because I know it's a good quality company. What about Diageo? Now, if we click into Diageo, they own like the beverages, so they own like Captain Morgan's, Smirnoff Vodka, very well-known consumer brand, one of the biggest companies in the UK actually, or on the FTSE 100. Now, they've got a dividend yield of 2.09%. Now, I mean, we could do the maths here and we could say how much would it require to get that at 2.09%. It would take about, I've done the maths wrong here, divided by that, it would take about £24,880 to get £10 a week in dividend income from this company. But when we look in the dividend history of this is where it's really remarkable. You want to see this staircase, this graph that is consistently increasing over time. That is a sign of a good quality company, a company that is in a very secure position that is able to grow consistently over time. Now, this isn't the best staircase I've seen, and there are companies of a higher quality, but you'll have to be doing that digging for yourself because you will eventually find them. But there are a few other things to look for. Firstly, what's their 10-year compound annual growth rate of their dividend? Well, it was actually 5.76%. That's pretty decent for a company of its size. During the most recent recessions, 2020, 2009, and the dot-com burst, have we seen a single cut on the chart? Not one. Now that says it's a very defensive brand and very much unimpacted by longer term economic trends. Now another site I like to use is companiesmarketcap.com. Now typically on this you can see the growth of their size over time, their market cap history. Now I wish it was up to date because sometimes one of the most useful features on this website is the shares outstanding. It will provide you a very clear graph, and what you want to see with shares outstanding, like you could do from 2001 to 2007 here, is that it's decreasing over time. Shares outstanding is the number of shares available in total. So as that number decreases, the value of each individual share increases. So you want to see that decrease over time. That's a very promising sign to see. Again, we can't truly tell here with Diageo without going onto a different website, which I'm not going to do for the purpose of this investment, but it's a good website to look out for when you're interested in this. Then we want to look at the dividend payout ratio, which is on Yahoo Finance. If you search for the ticker symbol, which is DGE, or just search in Diageo, it will come up. Then you want to scroll down all the way down here to dividends. We can see the payout ratio here is 53%. This means that 53% of the company's earnings is paid as a dividend towards shareholders. The other 47% of that income is reinvested back in the business via the management's choice. This means over time, if the business's earnings slow down, for instance, they're not growing their earnings as fast of a rate, well, they've got loads of room to really grow their dividends and therefore continue paying that dividend over time. Hence why maybe if their earnings slowed down in, let's say, 2020, which may have happened, may not have happened, they were able to continue paying that dividend and even grow on top of it. That's always a good sign to look out for. Now, you also want to check their balance sheet. Now, SimplyWallSt is fantastic for this because it's such a simple tool. I think you can get like a very free version of this that lets you look at a couple of stocks a month without having to sign up. I would definitely do that because you can look straight at the balance sheet and go, okay, what's their debt to equity? Okay, right, they've got a reasonable debt to equity. Obviously, a company of this size, they're going to be leveraging with their cash flow because they've got so much in earnings power that they can afford a higher level of debt, and their cash overall is 2.4 billion. You can't really complain with that much cash. That effectively identifies a company, or what you want to really be looking for is a company that has minimal debt, high levels of cash on the balance sheet, and ideally are growing their dividend over time. Now, if you can find a company as well that has a competitive advantage over those in the industry, Diageo's competitive advantage, for instance, is that they own a lot of consumer brands and they are well known. Their moat is their brand. It's like going, are you really going to buy Captain Morgan's spiced rum? Or are you going to buy this smaller one where it's called Red Leg spiced rum? Well, I'm going to go with the one I know. I'm going to buy that one. And that's why they're so powerful and able to generate so much in free cash flow. But as I say, you also need to be mindful of those companies with very high dividend yields. One quick look back at the FTSE 100 would indicate there are quite a few of them hanging about, and you never know if they're going to be doing well or not. A lot of the house builders at the moment are very high up in yields. You've got Rio Tinto here, one of the miners. Okay, that's dependent on the asset it's mining itself. I believe there are a lot of copper minings, and I don't really know too well on that asset class, but if it's a cyclical and it looks like that, it could be promising for the longer term, but again, one to keep looking into. Vodafone, for instance, is a telecom service provider. They have to spend a lot in capital expenditure just to maintain their current infrastructure, so they require heaps of cash flow to maintain that. And so it's very likely that with Vodafone, that whilst they've got a high dividend of 9.4%, which is better than the annual average return of the markets, right? If we actually Googled Vodafone phone share price, it's probably not increased really over that time. In fact, it's probably gone down. If we go back to the last 6 months, down 33%, last year 27%, last 5 years down 64%. So you can see even with a high dividend yield, their share price has effectively been stagnant since about 2002, even before then. Actually, since 1997, the share price has increased by 8%. So you can see that despite having a high dividend yield, as shown, they're not necessarily growing your overall money. So you need to be very mindful as that as well. I personally hold a few dividend stocks in my portfolio, one like Games Workshop and also the London Stock Exchange Group. In my self-invested personal pension, I also hold the likes of Kingfisher, Dunelm Group and a few others. So if you're interested in that, definitely click that subscribe button down below. Have a fantastic day. Peace.